This video is produced for educational and informational purposes only and does not constitute financial, investment, or legal advice. All facts about Luckin Coffee's accounting fraud are sourced from SEC enforcement documents, Luckin's own internal investigation findings, and reputable financial reporting. Luckin Coffee reached a $180 million settlement with the SEC in December 2020 and admitted to the misconduct. The company has since undergone full restructuring under new management and ownership. References to Luckin Coffee's current performance reflect publicly reported financial results. The Busila Breakdown is an independent channel with no affiliation to any company, brand, or individual referenced in this video. Always do your own research before making financial decisions. In 2019, a Chinese coffee company was the fastest-growing restaurant chain in history. It had gone from 0 stores to over 4,000 in less than 3 years. It had taken on Starbucks directly. Price wars, delivery battles, pure speed-to-scale aggression. It had raised over $800 million from global investors and was listed on the NASDAQ. And most of those sales figures were fake. Luckin Coffee had fabricated approximately $310 million in revenue. The transactions were invented. The customers, in many cases, didn't exist. The company's own internal investigation confirmed it. In 2020, Luckin was delisted. The SEC fined it $180 million. The founders were gone. And then something happened that almost never happens. The company survived. Today, Luckin Coffee has more stores in China than Starbucks. Its revenue has surpassed Starbucks China. It is planning to expand to the United States. This is one of the strangest business stories of the last decade. The company that committed one of the biggest accounting frauds in Chinese corporate history got caught and then became the market leader anyway. Chapter 1. The Rise. To understand what Luckin did, you need to understand what it was fighting. Starbucks entered China in 1999. By 2017, it was the dominant premium coffee brand. Over 3,000 stores, a reputation for quality, and a model built around the third place. Not home, not work. A comfortable space to sit, to meet, to spend time. Starbucks didn't just sell coffee in China. It sold a lifestyle that a growing middle class wanted to be part of. The problem with the third place model is that it is slow. It requires expensive real estate, trained baristas, and customers with time to sit down. For a market as fast-moving as urban China, some people believed there was a different version of coffee waiting to be built. In 2017, Luckin Coffee launched with a completely different thesis. No ambience, no third place. Just coffee. Fast, cheap, and delivered to your desk. The unit economics were simple and aggressive. Luckin priced its drinks below Starbucks. It pushed delivery hard. It opened small pickup windows inside office buildings and shopping malls. Low rent, high volume. And it used app-based ordering exclusively, which meant no cash, no queues, and a direct relationship with every customer's data. The growth was staggering. By the end of 2018, Luckin had opened over 2,000 stores. By the end of 2019, that number was over 4,500. For context, it had taken Starbucks roughly 20 years to reach a similar store count in China. Luckin got there in under 3 years. In May 2019, Luckin listed on the NASDAQ stock exchange. The IPO raised approximately $600 million. The company was valued at roughly $4 billion. Investors were buying into a simple story. China's coffee market was underpenetrated. Luckin had cracked the delivery and speed model. and the growth numbers were extraordinary. What very few people knew at that moment was that a significant portion of those growth numbers were invented. Chapter 2. The Scheme. In February 2020, an anonymous package arrived at Muddy Waters Research, a short-selling firm founded by Carson Block, known for its reports on Chinese companies with accounting irregularities. The package was 89 pages long. It alleged that Luckin Coffee was fabricating a substantial portion of its sales data. According to the document, approximately 88% of Luckin's daily order volumes had been inflated. The methodology in the report was detailed. Thousands of hours of in-store video footage from multiple locations, thousands of manual receipt counts, cross-referenced against the company's reported numbers. The gap between what was observed and what was reported was enormous. Muddy Waters published the report. Luckin's stock dropped sharply. The company issued a statement denying the allegations. Then, in April 2020, Luckin Coffee disclosed that its own special committee had conducted an internal investigation. The findings confirmed what the anonymous package had alleged and went further. The committee found that Luckin's chief operating officer, Jian Liu, had orchestrated a scheme to fabricate approximately $310 million in sales between the second quarter and fourth quarter of 2019. The mechanics of the fraud were layered. Fake sales orders were generated and then inflated through a network of related party transactions and vendor arrangements. Coupons were issued and recorded as redeemed, even when they were not. The transactions flowed through a structure designed to make the revenue look real on paper. The scale of what was admitted is worth pausing on. $310 million in fabricated sales, during a period when the company was actively raising money from international investors based on those exact growth figures. In December 2020, the Securities and Exchange Commission announced that Luckin Coffee had agreed to pay $180 million to settle charges of fraud. The company admitted the misconduct. The settlement did not go to trial. The facts were not disputed. Luckin Coffee had committed securities fraud on the Nasdaq Stock Exchange. Its own investigation confirmed it. The SEC enforced it. The fine was paid. The consequences moved quickly. In June 2020, Nasdaq delisted Luckin Coffee. The company's shares were removed from the exchange. Investors who had bought in during the IPO or during the period of inflated sales figures had no remaining recourse through the public markets. Total capital raised by Luckin during the fraud period was approximately $864 million. The founders were removed. Charles Liu, the chairman and a co-founder, was ousted. Jenny Chien, the CEO, was removed. Multiple executives involved in the scheme were sanctioned. COO Jian Liu, the architect of the fabrication scheme according to the internal investigation, was terminated and faced regulatory consequences in China. In 2021, Luckin filed for bankruptcy protection in the United States under Chapter 15, a provision designed for foreign companies with U.S.-listed debt or creditors. This allowed the restructuring process to proceed under Chinese insolvency proceedings while getting U.S. court recognition. The U.S.-listed securities were gone. The founders were gone. The executives who had built the fraud were gone. There was also a broader geopolitical dimension. The Luckin case accelerated scrutiny of Chinese companies listed on U.S. exchanges and their relationship with American auditing oversight. The Public Company Accounting Oversight Board, the U.S. body that oversees auditors of listed companies, had long faced resistance from China on its ability to inspect audit work papers for Chinese companies. Luckin's fraud, exposed despite Nasdaq listing requirements, added significant political pressure to that standoff. It was one of the cases cited in the eventual passage of legislation requiring Chinese companies to allow U.S. audit inspections or face delisting. Luckin's fraud, in other words, had consequences that extended far beyond Luckin. But inside China, the story was not finished. Chapter 4: The Comeback. After the founders were removed and the restructuring began, a Hong Kong-based private equity firm called Centurium Capital took control of Luckin Coffee. Centurium had been an early investor. It now became the vehicle through which the company was rebuilt. The question Centurium had to answer was whether there was a real business underneath the fraud. There was. The delivery model worked. The app-based ordering worked. The pickup window format in office buildings and transit hubs worked. The price point worked. The underlying hypothesis, the Chinese consumers wanted convenient, affordable coffee delivered to them quickly, was correct. The fraud had inflated the numbers, but it had not invented the model. Under new management, Luckin returned to growth. It was relisted on the over-the-counter markets in the United States, a lower-profile venue than NASDAQ, but enough for the company to maintain a public structure and investor access. More importantly, inside China, it kept opening stores. The pace of expansion after the restructuring was, if anything, faster than before. By 2023, Luckin had surpassed 6,000 stores, then 10,000, then 20,000. As of mid-2025, Luckin Coffee has approximately 22,300 locations across China. Starbucks, after decades of expansion in China, has approximately 7,000 stores. And in the second quarter of 2025, Luckin Coffee's revenue surpassed that of Starbucks China. That is not a close comparison. Luckin is not nipping at Starbucks' heels. It has become the dominant coffee chain in the country by store count and now by revenue, in a market that Starbucks had built and owned for more than 2 decades. The management team that ran the fraud does not exist at Luckin anymore. The founders are gone. The executives are gone. The COO who orchestrated the fabrication scheme is gone. The company operating today under the Luckin name is, in terms of leadership, ownership, and governance, a different entity from the one that committed fraud on the NASDAQ in 2019 and 2020. Luckin has also announced plans to expand to the United States. The company that was delisted from a U.S. stock exchange for fraud is now considering opening stores in American cities. Most corporate fraud stories end the same way. The company collapses. The executives go to prison or pay large fines. The investors lose their money. The name becomes a cautionary tale. That is the expected arc, and it is the arc that makes fraud feel like a story with a clear moral. Dishonesty destroys. Luckin Coffee does not fit that arc. The fraud was real. The SEC fine was real. The delisting was real. $864 million was raised during a period of inflated figures, and investors who bought those shares lost money they cannot get back. Those consequences were real, and they were serious. But the company survived, and it did not merely survive, it became the market leader. This creates a genuinely uncomfortable question, and I want to be honest that there is no clean answer to it. One reading is that this is a perverse outcome. A company committed large-scale fraud, paid a fine that was a fraction of what it raised during the fraud period, restructured under friendlier conditions than it deserved, and emerged stronger. If that is the lesson the market takes, it suggests that fraud, if you are large enough, and if the underlying business is viable enough, can be a survivable strategy. That is a troubling signal. The other reading is that the restructuring worked exactly as it should. The people who committed the fraud were removed and sanctioned. The company they built, stripped of its dishonest leadership, turned out to have a genuine product-market fit. New investors took the risk of restructuring it, and the market rewarded them because the coffee model was real. The punishment landed on the fraudsters. The business survived because businesses are not the same as their founders. Both of those readings are defensible. And the reason luck in coffee is worth studying is precisely because it does not let you choose one cleanly. What it does tell you is this: the market model worked. The delivery thesis was correct. The speed and scale approach outcompeted the third-place model in the Chinese urban market. And it tells you something less comfortable: that it is possible to build a real business on a fraudulent foundation, and for the business to outlast the fraud. That is not a lesson about coffee. That is a lesson about how markets judge value, and whether punishment and accountability always travel together. Thank you for watching the Busila Breakdown. If this story made you think, share it with someone who should hear it. New episodes every week.